China's economy shouldn't be thriving the way it is. Conventional economic theory suggests that government control stifles innovation and free markets promote growth. And yet China has some of the world's fastest growing tech companies, as well as cutting edge infrastructure and a booming consumer economy. So now you might be wondering, what's going on? Well, in this video, that's the question that we're going to break down exactly. And we're going to break it down into three parts. One being the traditional market theory, two, how China defies that theory, and finally, whether or not it's sustainable. If you've taken some sort of economic course in the past, you've probably heard the idea that extensive government regulation can often inhibit or deter the growth of an economy, while a free market tends to allow that sort of growth to flourish and overall productivity and efficiency to reach its maximum. And when you look at it from an economic perspective, that's because when you have fewer regulations, there's more competition between the firms, which further promotes innovation and growth and development in technologies and production. And when there's less regulation, there's more growth for firms themselves, so they're more willing to take risks that might allow for more growth overall, but could pose potential cost in the short run. But without those regulations, the firm, in consideration of its potential profit, it may be more likely to engage in those risks in order to receive an overall larger return. And central planning, where the government is all in and puts lots of restrictions on the companies and the businesses and the enterprises, tends to lead to a less successful and less economic thriving sort of economy. But China doesn't quite fit this original traditional economic theory. It has a government that highly regulates countless industries, controls financial markets, censors the internet, and yet somehow it's a global economic powerhouse. So what exactly is going on here? Unlike traditional free market economies, China runs on what some call state capitalism. Essentially what that means is that the government plays a direct role in major industries, funding infrastructure, supporting key businesses, and shaping market trends. But at the same time, private businesses still have the opportunity to thrive under a competitive market system. So it's kind of like capitalism, but with government training wheels. So let's dive deeper into how China's economy sustains rapid innovation with heavy government involvement. AI would be a perfect example. In this industry, government-backed investments play a major role, but instead of crowding out private investors, they actually attract them. Let me explain how this works. So China has 1,863 government VC funds ranging across industries, which obviously includes AI. But unlike private VCs, government funds don't just go towards rich big tech hubs. They're spread more across the country, especially in underdeveloped regions, to kind of promote the growth there as well. And now you might be like, Eve, that's great and all, but why? Why would the government do that? So as you might expect, private VC funds cluster in wealthy coastal regions such as Beijing, Shanghai, and Shenzhen, whereas government funds often try to target areas that private VC funds tend to ignore. And this creates like a more balanced investment map overall. And instead of avoiding government-backed firms, private VCs tend to use them as a market signal, which is essentially meaning that they're using the investments to gauge the potential of a certain company and whether or not it's worth their investment. In fact, 52% of government-backed firms later receive private funding investment. 71% of firms received government funding first, meaning that government money can often validate a firm's potential, which can then attract private investors to further help develop their technology, which is actually beneficial in the long run. So rather than stifling private investment, China's government is actually guiding it in a sense and giving it a sense of direction. Instead of a free market driving innovation, the government kind of plays matchmaker and picks out winners that would have otherwise been overlooked likely by private investors, and thus giving those smaller companies an opportunity to grow. But whether this kind of tactic and strategy will be sustainable in the long run is not yet clear. So far, there have been remarkable results as companies like Huawei, SenseTime, and BitDance have become global leaders in AI and big data, not despite government intervention, but because of it. China's e-commerce sector, led by giants like Alibaba, has thrived under government-backed digital payment infrastructure, especially with platforms like Alipay and WeChat Pay, which allow for cashless transactions nationwide, which as a student at Peking University, I found to be a very big change in terms of how easy it is to just have someone scan your QR code and pay directly through that. Literally anywhere you go, almost anywhere, they will take WeChat or Alipay, which is very convenient. And so contrary to what you might think, government regulation in China hasn't stifled e-commerce growth at all. In fact, it's actually helped the platforms scale on a great level. For one, strict internet controls, including the Great Firewall, have blocked or restricted foreign companies like Amazon, eBay, and Google from fully entering the Chinese market. This protection has allowed homegrown giants to continue expanding without facing major international rivals and almost giving them a virtual monopoly over the marketplace. Beyond protectionism, government policies has also accelerated e-commerce growth. The Internet Plus strategy, launched in 2015, promoted digital transformation across industries by integrating mobile payments, big data, and cloud computing into traditional business sectors. This encouraged many small businesses to move online, which further helped expand platforms such as Taobao and JD.com. The government backed the development of small logistics hubs, which optimizes supply chains using AI and data analytics. Additionally, China's high-speed rail and highway expansions allowed for faster nationwide delivery, which reduced logistic costs and enabled platforms like JD.com to fulfill same-day and next-day deliveries in most major cities. And of course, the government's push for a cashless economy has further smoothed online transactions and increased consumer confidence in e-commerce as a whole. Of course, this model isn't perfect. Heavy government intervention also comes with serious risks and potential costs. One of the biggest concerns right now being China's real estate crisis. For years, property developers like Evergrande and Country Garden thrived on easy access to credit and government-driven urbanization policies that encouraged rapid construction. Real estate became a key driver of China's economic growth, contributing nearly to 30% of GDP at its peak. But a lot of this growth was actually fueled by speculative buying, and developers were borrowing excessively to fund new projects. But as you might expect, demand slowed, and the government imposed the 3 red lines debt limits, which restricted new borrowing. And so large companies like Evergrande collapsed under massive liabilities, which in turn led to unfinished housing projects across the entire country. But of course, the crisis extends beyond developers. Local governments often rely heavily on land sales for revenue, and the whole situation caused an accumulation of trillions in hidden debt through off-the-book financing vehicles. So as land sale declines and debt continues to rise, there are increasing concerns over what's going to happen with this whole situation, as well as questioning the overall financial stability of the nation. While China has excelled in AI infrastructure and e-commerce, there have been other sectors that they've been thought to be over-regulating, and people have started questioning whether that has actually stifled the potential innovation of the country. For instance, China's sudden implementation of restrictions on the gaming industry has raised many heads and caused questions as well. These restrictions include limited playtime for minors, as well as freezing new game approvals, which has caused Tencent, one of the world's largest gaming companies, to lose hundreds of billions in market value. Similarly, reforms in private education, such as banning the private tutoring of core subjects, has wiped out billions from companies such as New Oriental, which has forced major industry players to pivot or shut down. Additionally, in social media, platforms like Weibo and Douyin, which was the original version of TikTok, operate under heavy content moderation. And this in turn limits their ability to function as truly open platforms and allow their users to get the full experience when there are certain things that are restricted on those platforms and certain creative minds, you could say, that aren't able to express themselves. But overall, China's economic model has continued to defy traditional economic theory, but I think the biggest question that we're all probably wanting to ask is this sustainable? With slowing GDP growth, a declining population, and increasing scrutiny on China's businesses, I think it's a very interesting question to consider whether China's intervention will continue to fuel economic growth or if it might in turn backfire. Although I don't have an explicit answer to that question in this video today, I'd love to hear what you guys think. Let me know down below in the comments on that question that I asked, or if you have any thoughts on the situation in general. If you enjoy content like this or would like to follow me on my journey as a finance student at Peking University, please consider subscribing, and I'll see you guys in the next one.